And welcome back. It's Jason Walty here. I have a lot to share in today's video because a couple days ago, the Federal Reserve Bank of Dallas just released a research paper regarding are we currently in a housing bubble in the US? They provide some really interesting insights regarding what's happening right now and how this compares to 2008, for example, and some pretty interesting trends. So with that said, let's go ahead and dive right into the video. But first, if you guys haven't subscribed just yet, I post frequent housing market updates so you guys can be more informed. I really enjoy making these videos for you guys, so hope you guys get a lot of value out of them. And with that said, let's begin today's video. This is again from the Federal Reserve Bank of Dallas, and they just announced this on the 15th of November here. It says US home prices appreciated a remarkable 94.5% from the first quarter of 2013 through the second quarter of 2022. And it says the magnitude of this increase is even larger than that of the preceding housing boom from the first quarter of 1998 to the second quarter of 2007. I mean, how wild is that? That means that home prices almost doubled from 2013 until now. And I actually have some data to support their claims here that home prices increased by 94.5%. Let's go on to Uncle Fred's website right here regarding home prices for brand new houses. I would show you guys existing home sold prices according to the National Association of Realtors, but on Uncle Fred's website, they only provide 12 months back. So I really want to go back all the way to the first of 2013, January 2013. And these are for the median sold price for brand new houses in the US. So back in January 2013, the median sold price for a brand new single family home was only $251,500. And fast forward to July 2022, the median sold price increased to $479,800. And by my math, that's a 91% increase in home prices over that period. And they go on to say the following in this report here. House prices have risen especially rapidly since this pandemic began, as you guys all know if you follow the channel, from the first quarter of 2020, obviously until the second quarter of 2022. Accounting for roughly 40% of home price appreciation during that time frame. So they're saying that home prices increase around 40%. Of course, it depends on where you live or what different city you're talking about here. But home prices increase about 40% from the first quarter of 2020 until the second quarter of 2022. And it says here measures of profitability, which is a price to rent ratio, which is obviously for people looking to buy an investment property, looking at the home sold price to what you get for rent for the property. And affordability, which is their price to income ratio, your home price compared to what you make as a living, has also jumped in the past 2 years. So these two ratios here, price to rent as well as price to income, have jumped in the past 2 years and also past historical highs dating back to the first quarter of 1975. And it says here, this unprecedented pandemic boom poses an outside risk for the US economy. The possibility of a sharp price correction leading to an economic contraction would further complicate the Federal Reserve's inflation fighting efforts, which of course is rising or increasing the federal funds rate. And they make a good point regarding this because, of course, the Fed is increasing the federal funds rate in order to combat inflation. Inflation's over 7% right now. And because inflation has been so high, that's why the Fed has been increasing the federal funds rate. And when the Fed increases the rates or rate of the federal funds rate, that causes in general to cause mortgage rates to increase. And that's one of the main reasons why we've been seeing increases in mortgage rates because the Fed has been increasing rates. And so the Fed's kind of stuck between a rock and a hard place here, potentially, because if we see a huge correction or big correction in our housing market, yet inflation's still historically high, the Fed's going to have to kind of waver between should we continue increasing rates, and that's going to cause a further correction in our housing market, or should we ease off? In this report by the Fed, they also talk about this initial home price surge that we saw over the past couple of years. It says robust disposable income supported by pandemic-related fiscal stimulus and cheap credit, which of course is due to record low mortgage rates, boosted consumer demand. While on the supply chain, though, we had supply chain disruptions, COVID-19 related lockdowns, and rising labor and raw construction materials those costs push supplies lower, of course, for building brand new houses. We also had, of course, new work at home arrangements and internal migration as well, which also help explain why demand so outpaced housing supply early on. I mean, I've been a real estate agent here in the greater Sacramento area. We helped more people move here, moving from the Bay Area, Los Angeles, Texas, all over the United States into Sacramento because people had new work at home arrangements. They had a house in which they didn't have an office, for example, and they didn't have to be close to their office. So they moved to more affordable areas like the greater Sacramento area, for example. And the Federal Reserve Bank of Dallas also went on to say the following: a housing boom such as this pandemic era run-up that we had over the past couple of years becomes frothy when the belief becomes widespread that today's robust price increases will continue unabated. I always talk about this, that we can't have home prices increase by 20% every single year and expect that to continue every single year, right? We have this housing affordability issue in the US, and also home prices are not going to increase indefinitely. And we're seeing that right now because home prices have been decreasing more or less ever since June of this year on a national level. And if many home buyers have this belief that home prices are not going to decrease, it says here, if many buyers and investors share this belief, purchases arising from a fear of missing out, or FOMO, further drive up prices and reinforce expectations of strong and accelerating future gains beyond what fundamentals could justify. And this self-fulfilling mechanism leads to exponential price growth until a price correction inevitably occurs. So home prices cannot increase forever, and eventually a home price correction will eventually occur. They also provide some really good insights regarding some things to identify that's a symptom of a housing market bubble. It says here how to identify unsustainable exponential growth, a symptom of a housing bubble. And they have what's called exuberance statistics. And these measures can help detect if and when housing market indicators, which are quarterly real house prices, which is quarterly home price changes or increases, the home price to rent ratio, as well as the home price to income ratio, if those start increasing exponentially, that would be a symptom of a housing bubble. And it says here an exuberant stat above 95% threshold signifies 95% confidence of abnormal, unsustainable behavior in the underlying data series. So here's a chart showing those three stats right here, going back to Q1 of 1982. The green line is the price to rent ratio, red line is the price to income ratio, and the blue line, which is right here, is the real house prices or changes in home prices over time. As you can see right here, again, we want to see the exuberant stat above 95%, which would signify a 95% confidence of abnormal and unsustainable behavior in the data here. And as you can see right here, for all three of these ratios here, they're well above 95%. So home prices, the index is at 125.8. The price to rent ratio is 108.7. And also the price to income ratio is 104.8. Of course, all above this threshold of 95%. And also, as you guys can see right here, their index for home price gains is well above the peak we had back in 2007. And also the price to rent ratio is also above as well. The price to income ratio is very close to the bubble back in 2007. And by the way, this data right here only goes through the second quarter of this year. So once the third quarter is released here, of course, I'll make a separate video regarding that as well. They also say here home prices adjusted for inflation rose 24.3% from the first quarter of 2020 to the second quarter of 2022, the largest 9-quarter gain since the mid-1970s and more than 3 times the rate of growth of the prior 9-quarter period. And that would be from the fourth quarter of 2017 to the first quarter of 2020. And it says here the latest stats from the second quarter of 2022 closely parallel the preceding housing bubble, with the data once again showing evidence of explosive behavior in the price to rent as well as the price to income ratios as well. And check this out. It says the pandemic surge before the summer of 2022 exhibited widening symptoms of a FOMO-driven bubble, one that extends beyond the United States. They also talk about the Fed's monetary policy and the role in easing the housing boom. And it says here, the relatively high number of new houses currently under construction can be a silver lining, since supply catching up with demand can take some air out of this housing market and, of course, curb our housing affordability issues we have in the US. However, though, it says completions of these houses continue to lag. And take a look at this, because here's a Fred graph here showing new houses for sale by stage of construction, which would be under construction, which is the blue line right here, as well as houses completed, which is the red line. So let's first have a look at houses under construction that are currently for sale in the US, at least as of the end of July. And by the way, we're only going to July 2022 because the data in this report here by the Fed only goes through the second quarter here. In any case, let's have a look at this, because these are actually only single family houses. These exclude multifamily properties. So again, the blue line right here is our new single family houses for sale that are under construction right now. And that's 324,000 right now, which is on par with the numbers we saw back in August of 2006, because at that time we also had 324,000 single family houses for sale that are under construction. So the total number of houses under construction that are for sale right now are the highest levels since August of 2006 right now. But look at this though, because as he mentioned here in the report, completions continue to lag. And that's absolutely true, because as of the end of July, only 40,000 houses for sale that are completed right now, which is vastly different compared to, let's just call it March 2020, when there was 76 houses completed that were for sale. And let's go back right here, because 80, which is right there, in February of 2020, there was 80 houses completed that were for sale. So more or less double the share we have right now. And also going back, let's actually look at 2018, for example, July 2018. So in July 2018, there were 61,000 houses completed that were for sale. And again, there's only 40,000 right now. And I'm mentioning 2018 because that was the most recent year where mortgage rates were actually increasing. Rates in 2018 only increased by about 0.5% for the entire year. And of course, this year, rates have doubled from 3.3% all the way to about 6.6% right now. So of course, it's kind of hard to take a look at a year more recently where rates have been increasing so much. But anyways, back in 2019, rates were decreasing, and same for 2020 as well. So 2018 is probably the most recent year where we saw rates actually increase. Anyways, back then there were 61,000 houses completed that were for sale. Now there's only 40,000. And also going back to the bubble years, let's look at this. Back in 2008, for example, look at that. December 2007, for example, there was 198,000 completed houses that were for sale. Now there's only 40,000. So big difference compared to the bubble years. And going back to the Fed's report here, it says achieving a soft economic landing, which of course is taming inflation and of course avoiding a recession, like the Fed accomplished back in 1994, cannot be taken for granted given the further monetary policy tightening by the Fed, and that can increase the household mortgage debt servicing burden. In other words, causing a burden for households in order to pay their mortgages. And on top of that, that can boost the odds of a severe home price correction. They also talk about in this report here, is the housing market correction unavoidable? It says in the current environment, when housing demand is showing signs of softening, monetary policy needs to carefully thread the needle of bringing inflation down without setting off a downward home price spiral. Increasing mortgage rates reduce the risk of prolonging the housing price boom. In other words, the Fed really has a hard job ahead of them because they really have to continue to raise rates in order to combat inflation. But in doing so, they're causing the housing market to decrease, or actually causing the housing market to slow down big time. And so it's going to be interesting to see what they do in the months ahead, given the fact that home prices and the housing market has been slowing down big time, but inflation has only started to slow down. And they actually kind of touch on this as well, because they say a gradual unwinding of the pandemic housing excesses can occur if policymakers can quell or decrease inflation without putting buyers under too much stress, and can slow home price and rent increases while keeping underwater mortgages from rising. And households and financial institutions are in better shape right now than during the housing boom and, of course, bust in the mid-2000s. And they conclude this article by saying the following here: a severe housing bust or severe housing correction from the frothy pandemic run-up is not inevitable. In other words, it is avoidable. Although the situation is challenging, there remains a window of opportunity to deflate the housing bubble while achieving the Fed's preferred outcome of a soft landing. I'd love to hear from you guys. If you guys are still watching the video, I would definitely appreciate you guys. But what do you guys think? Do you guys think that the Fed can accomplish a soft landing like they've been talking about for quite some time? Leave me a comment below. Also, if you guys got any value to this video whatsoever, then please hit the like button. Greatly appreciate that. Hope you guys have an awesome day, and look forward to seeing you on the next video.